Exactly a decade ago, the world was hit by the worst economic crisis since the Great Depression in the U.S. Trillions of dollars were sucked out of the global economy, tens of millions of people lost their jobs, and austerity economics was imposed across many countries. Here at The Listening Post, we reported back then on the failings of the financial coverage, failings that meant the crash came as a huge surprise to many around the world. The financial press cheered on a bubble that eventually burst, showed a lack of skepticism about Wall Street claims, and failed to expose what was, in effect, mass fraud on their own beat, namely the mis-selling of mortgages to millions of Americans. In the aftermath, some outlets apologized for the shortcomings in their reporting. But 10 years on, how much has actually changed? The Listening Post's Meenakshi Ravi now on the lessons of 2008 and the new challenges facing reporters on the business and economy beats today.
Right now, breaking news here, stocks all around the world are tanking because of the crisis on Wall Street.
2008 was a year of reckoning for governments, regulators, financial institutions, and the journalists who reported on them.
Today, the Z DAX over in Frankfurt is down by 9%, the Paris market down by 9%, Austria, which was briefly suspended.
It was like a war zone. Think about it, the institutions that had been around since the Great Depression, Bear Stearns, Lehman Brothers, Merrill Lynch, for all intents and purposes, disappeared during this crisis.
There's the bankruptcy of Lehman Brothers, the sale of Merrill Lynch to Bank of America, and word of trouble with the world's largest insurance company, American International Group.
Most of what drove the financial crisis was not concealed by some dastardly James Bond-style plot. Most of it was just widely ignored by the public and politicians and most journalists.
You know, this shakes your core. This shakes your trust in American institutions.
Most of the coverage leading up to the crash ignored the really central problems, which was that fraud and predatory tactics were rife, and they were really what drove the crash.
This is America. How many of you people want to pay for your neighbor's mortgage that has an extra bathroom and can't pay their bills? Raise their hand. How about we all?
No matter how critical we are of financial journalism, it molded itself around a system that was unsustainable. That was its failure. But let us never forget that it was malfeasance, miscalculation, and misregulation that caused the problem.
In the years leading up to the financial crash, global stock markets hit new highs. Real estate was booming. Investment banks used ever more complicated financial instruments, primarily collateralized debt obligations, CDOs, and credit default swaps, CDSs, that not only enabled riskier and riskier mortgages to be given, but allowed banks to make more and more money off them. When people started to default en masse, the banks found themselves in too deep. In a world in which banks relied on borrowing from each other for survival, it set off a domino effect.
Before 2007 and 8, very few mainstream financial outlets were looking at the world of complex credit and derivatives and subprime mortgages and debt. I wrote about it a fair amount myself because I became absolutely fascinated by the question of what on earth are the geeks doing in these dark corners that we don't understand. Most journalists thought that those kind of areas of finance were boring and technical and dull, and you couldn't get it on the front page of a newspaper, you couldn't get it on the top of the running of a television show, so that whole world got totally ignored.
Financial journalists in particular began to understand that all the nuance and the details of these incredibly complex instruments mattered. But at the same time, if you were out there saying, oh my God, watch out for CDSs, watch out for CDOs, you were treated like somebody wearing a tinfoil hat. You were not considered somebody who understood finance.
Probing the culture of the financial press is central to any critical examination of its performance. In the years after the crash, critics on the outside and voices from inside the newsrooms pointed out some of the most problematic aspects of how the financial media operates.
Hey, Warren, my man, Creighton, did you?
They cited groupthink, a reliance on access to industry insiders, and crucially, a sense that financial reporters have to be as enthused about the bottom lines of the companies they report on as the business's executives themselves.
It's like covering a sports team. You have a tendency to start cheering because it's more exciting to cover something where there's lots of money rolling around and profits are high. And by defining it that way, you're really sort of limiting your scope of vision. You know, how are consumers treated? What are the checks and balances within the company? Those kind of things often are forgotten. If a company is doing well, if a market is booming, it's very easy to just sort of let the good times roll.
One of the really big things that's happened around the start of the 21st century was that television in the financial world and markets became much more important. It's much easier to convey a sense of manic excitement through a television studio interview than it is in the pages of a newspaper or a wire service.
It's fair to say that people like me who questioned the system and the sustainability of the boom, we weren't shouted down, but you were looked on as a kind of unnecessary troublemaker. There was a cultural pressure to say, well, if the great and good say it goes on forever, it goes on forever. Especially because in the background, you've got these relentless channels of kind of one-dimensional, weird propaganda for the bottom line. You know, the American business channels. It's easy to get sucked into their world.
There's a question to be asked about audiences and how their interests shape journalistic output. The financial press is consumed in large part by a niche group: traders, investors, bankers, and CEOs. What's good news for them, say for instance company mergers or credit bubbles, are often reported positively by the financial press. What often goes underreported are wider impacts and concerns. This can be contagious because so many mainstream outlets take their cues on business and financial reporting from the specialist press. And then there's the question of sources. Business journalists rely on their relationships with the executives they report on for stories. Access is priceless.
When you go to your annual shareholder meetings, do you get a standing ovation for what you've done?
There is a careful balance of being able to get the CEO to come back on your channel and being able to get the CEO to give you some news. I don't think that, in my experience of either Bloomberg or CNBC, we ever pulled punches. We worked really hard to actually give difficult interviews. You need to ask the question in a way that isn't rude, because the viewers will immediately think you're being awful to this guest that you've invited on your show.
In the aftermath of the financial crisis, there's been a lot of introspection by the media. Journalists had to face the failings of their work before 2008 and reassess their approach to the finance and economy beats. There's still work to be done.
The media is still very obsessed with the issues that created the last crisis. The one thing we can count on is that the next crisis won't come from exactly the same area. It will be something else, like what's happening with the pension system today, what's happening with, say, exchange-traded funds, what's happening with other areas of financial technology, fintech. Plus, there are other areas of our life where you have, once again, geeks in control of a technology that no one else understands.
I think that the financial media has become a bit more skeptical post-2008, but I wouldn't say that there's been a massive culture change. We're not thinking about the health of society, health of a nation, how well customers are being treated. That's really kind of a secondary thing. So that does worry me, but that says there has been some really good reporting. The Los Angeles Times did great reporting breaking the Wells Fargo fake account scandal. But in general, there are a lot of financial stories out there that aren't getting the kind of digging, investigative reporting that they merit.
I think there is a strategic mismatch between much of journalism and the kind of world that we live in. Business journalism cannot be like sports journalism. It has to ask the question, should this match even be being played to the rules it's being played? Sports journalism cannot ask that of a football match. We must ask that of a banking system. Are the rules right? Are the players all crooks? Is the game futile? Is it destroying the society we live in?